back to Dollars and Cents with Freedman Financial on North Shore 1049. My name is Marc Freedman. I'm President and CEO of Freedman Financial, located in Peabody, Massachusetts, right across the street from the North Shore Mall and just above Alto Forno Restaurant. If now is the time for you to get serious about your financial planning, for you to get your financial house in order, I hope you'll give us a call, 978-531-8108. That's 978-531-8108. You want to learn more about the firm? Go to visit our website, freedmanfinancial.com. That's Freedman, two E's and a D, financial.com. Go anywhere on the page. I mean, we write our own newsletter. I've read our own website and our own newsletter, of course. It amazes me how many financial advisors I look to learn from by just doing some searches on the web. And I find that 9 times out of 10, even the independent advisors have not created their own website. They buy a canned website. Oftentimes at the bottom of any website you go to, certainly through a financial advisor, you can see something, sometimes it says FMG Suite. FMG Suite is one of these companies where you can just buy their template. I sign up for newsletters, just like I have a newsletter that I offer out to many financial advisors, many listeners, anybody who wants my free weekly newsletter. It's called Planning Pointers. It lands in your inbox on Friday at 10:30 in the morning. All you need to do is go to my website, freedmanfinancial.com, go to the bottom of the page, put in your name, your email address. You want to leave me a message, that's great. But we will set you up with our free weekly newsletter that has had, I guess it's 700 consecutive issues now, going back to 2008, 2009. It's really remarkable. And we write every single one of our newsletters. And people say to me, Mark, the thing that I love about your newsletter, and there's over 7,500 subscribers, I love the titles. The titles are always pretty catchy. I'm trying to think of what my title was for this week because I already submitted it, but I don't know, it doesn't matter. But what's interesting to me is the number of people that sign up for my newsletter with the 7,500. Almost 2,000 of the subscribers to my newsletter are financial advisors themselves. And that's fine. I mean, I'm happy to share information. That's all good. But oftentimes when they subscribe to my newsletter, I in turn sign up for many of their newsletters. And what amazes me is on a Tuesday every month, I might get 50 or 60 newsletters that show up all at the same time. And they come from 50 or 60 different financial advisors, all with the same title. It's all the same newsletter. It's just a different face in the upper left-hand corner. Folks, when I talk about providing you with financial advice in a language you can understand, it's advice that's coming from us. We write our own newsletter. We write the messages that we provide to you. When we meet with you and give you advice, we provide our advice in writing afterwards. Every time you visit my office, we do what's called a memo to file, where I write a story. Actually, I dictate it. I dictate a story about what happened in our meeting, so that I have a reference point, my entire staff has a reference point of what we talked about. In addition to that, I follow up with a thank you letter or some kind of a communication to you that says, thanks for visiting the office. Here's what we talked about today. Here's what we agreed we were going to do. I'm not hitting a button that says, well, send, template 1A/B because we talked about that issue. No, I dictate, or my business partner or someone in the office dictates a letter that captures what we talked about. Our relationship at Freedman Financial is very personal. And it needs to be personal when you reach a point in your life when you need to get serious. In the accumulation phase of your life, trying to save as much money as you can, just doing the best you can, that's great. And you should continue to do that and work with financial advisors to help you do that. But all of a sudden you're going to get to a point in your life when you're 50 years old, 55, 60, and you're beginning to think, oh my goodness, retirement is right on the horizon. And I'm not so sure I know what all this stuff is that I have, what it all means. How will it impact my life? How will I be able to create an income stream after the paycheck stops? That is when people start calling Freedman Financial. That's when they call my firm. Because they say, it was fun dealing with all these people, but now I gotta get serious. And now I want somebody that's really going to track not just the performance of my investment account, but the performance of my net worth, give me advice on all aspects of my financial life, from selling my home to downsizing to buying a car to helping with my aging parents to how do I pay for my kids' education. All those questions and then some and even more. That's what we do at Freedman Financial. If now is the time for you to get serious about your financial planning, I would encourage you strongly to contact our office, schedule a free initial consultation in our office. Phone number is 978-531-8108. That's 978-531-8108, and experience what real personalized financial planning advice is all about. When we last left, I promised you I was going to give you the answer to the question of why investors, you and me, average investors, typical people that like to invest their money, why they continuously underperform market indexes. And all of the advice that I'm providing you today comes from a survey, comes from a report that came from DALBAR, the Quantitative Analysis of Investment Behavior. DALBAR, if you want to know who they are, they provided me with who DALBAR is. I'll even read this to you if you want to know. Since 1994, DALBAR's Quantitative Analysis of Investment Behavior has measured the effects of investor decisions to buy, to sell, and to switch into and out of mutual funds over short and long-term time frames. These effects are measured by the perspective of the investor and do not represent the performance of the investments themselves. The results consistently show year after year after year after year that the average investor earns less, in many cases much less, than mutual fund performance reports would suggest. And here's one of the big reasons why. If you want to pick an investment, you sit down with your financial advisor, or maybe you do it yourself, and you look at the menu of mutual funds that are out there, or the mutual funds, exchange-traded funds, index funds, whatever it is that you might be able to buy. And you start to make a decision, well, how do I choose from the 20 or 30 funds that are out there? How do I choose the one that works for me? Well, what's one of the major criteria that we look at? Time horizon. How did it do over the past 5 years, 10 years, 15 years, and 20 years? You want to make sure that those mutual funds have performed well through all different types of market cycles, because you're a long-term investor, right? Well, here's the problem. S&P 500, when you invest in the S&P 500 index, or when you're following or watching the S&P 500 index, they're going to give you continuous performance 1 year, 3 year, 5 year, 10 year, 15 year, 20 year, 25 year, 30 year, because nobody's adding money to it, no one's taking any money out of it. You're just going to get straight performance. You're not getting out, they're not getting in. But the average mutual fund investor who's trying to beat the S&P 500 does this. Get this. The equity fund, average equity fund retention rate is at 4.03 years. That means when you buy a mutual fund, the average person holds a mutual fund, a stock-based mutual fund, for 4 years. So what was the point of looking at the 5-year, 10-year, 15-year, and 20-year track record? It's because we believe, oh, this time it's different, Mark. This is different. You know, now that we got Trump in office, this time it's different. Or now that we've got China, or the Hong Kong airport shutting down, this is different. Or North Korea acting the way they're acting. Or the immigrant issue, this is different. Or the gun issue, this is different, Mark. You don't think we've gone through hills and valleys in our history? We've gone through world wars. We've gone through horrible, horrific terrorism. We've gone through a banking crisis where the financial institutions almost shut down completely. Yet this time it's different for a really long extended period of time? I don't think so. And remember, when you're looking back historically, 5 years, 10 years, 15 years, 20 years, of all of that mutual fund performance, remember those mutual funds lived through those hills and valleys already. So how is this different? Well, Mark, I don't buy green bananas anymore. That's what some people might say to me. You know, well, if you're not buying green bananas, you have no business being in the stock market. I mean, if you're not buying green bananas, that's a problem. If you're a long-term investor, you're a long-term investor. You can't be worried about the day-to-day fluctuations that happen over a year, even 3 years or 5 years. They're gonna happen. We're likely to have another 10% drop in the stock market this year. We'll likely have one next year. We might even have a 20% drop. Who cares? If you're a long-term investor, who cares? Here's what's rather interesting. That retention rate, how long people hold on to their funds, their stock-based funds, 4.03 years, has been static for years. Nothing's different. It wasn't different in 2008. That's about what it's been. However, if you're a bond fund investor, your retention rate dropped by almost 6 months, from an average of 3.45 years in 2007 to an average of 3 years, 3.04 years in 2018. Now that, to me, is remarkable. Remember, bonds were supposed to be the safe investment. I'm using quotation marks with safe. But people traded in and out of those. Oh, that's probably because you heard, oh, interest rates are going up. Better get out of my bonds because those are going to go bad. Well, how'd that work out for you last year and the year before and the year before and the year before? Interest rates have actually gone down. No one was expecting it, but they went down. Interest rates go through cycles just like stock markets go through cycles. Be a long-term investor. Work with a financial advisor who will tweak your portfolio. How about this? The average asset allocation fund. Remember we talked about that 60-40 split thing? The average asset allocation fund retention rates dropped by more than 2 months last year, from 4.65 years in 2017 to 2.52 years. So let's call it 4 years, folks. The average investor is making wholesale changes in their mutual funds, whether it's stocks or bonds, approximately every 4 years. There's one thing that I've been saying since I started in this business back in 1991. It was pretty radical for me to say it to the face of representatives of mutual fund companies back in the 90s and early 2000s. And now, the mutual fund companies believe every word that I'm about to say to you, yet they won't say it publicly. Folks, at the end of the day, because of investment behavior, a fund is a fund is a fund. You want to buy, I agree, you need to buy a large cap growth fund. You need to have a large cap value fund. There's probably 6,000 in each category. But you're never going to find the best one. You'll find a decent one, an average one, above average one. You can certainly screen out the lousy ones. But at the end of the day, all of those that fall in that average and above average category, they're all about the same. Now, the portfolio manager won't think so. They're going to tell you why they're so much better than the next guy, because there's an ego attached to that, of course. That makes sense. But at the end of the day, a fund is a fund is a fund. And I said the only thing that changes, because this week I'm going to San Diego. I'm going to go to an investor conference with LPL Financial. And they'll be in this big exhibit hall in the San Diego Sales Pavilion, that's Sales, S-A-I-L-S Pavilion, out there in San Diego. There'll be 10,000 people there. There'll be hundreds of booths. Every mutual fund, every investment company you could imagine will all be there with their tables, hucking their stuff, encouraging us to use their investment strategies, their funds. They've all been there. It's the same ones that were there 20 years ago. The only thing that's changed is the table that the wholesaler of the fund is standing behind. I could go 4 years ago and I might see the guy from Putnam, or the guy from Fidelity, or the guy from Vanguard, standing there telling me all about the great things with their fund. And I'll go back this year, and the guy from Putnam is standing behind the Pioneer booth. And the guy from Fidelity is standing behind the Prudential booth. And the guy from wherever, they all move around. The only thing that changes in this business is the table that the wholesaler stands behind. What you need to develop, what you need to create when it comes to investing is an asset allocation strategy. Should you be 60-40? Should you be 70-30? The actual selection of the investments does not matter, especially if you're picking mutual funds. But that strategy needs to align with your overall goals. It needs to align with your overall plan. Because when you're approaching retirement, when you're in retirement, you need to know that a strategy is in place designed to withstand the fluctuation, the volatility that goes on in economics and the markets every single day. That, my friends, is what I call financial advice in a language you can understand. We got to get out of here. But we will be back next Sunday with much more. Thanks for tuning in. My name is Marc Freedman. You're listening to Dollars and Cents with Freedman Financial on North Shore 104.9.
A dollar, 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 that's what I need. And if I share with